Tell us the story of AIG in a nutshell, Matt. I mean, you lay it out in depth in your piece, The Big Takeover. You talk about a revolution by insiders. You say AIG is a great kind of in microcosm story of what went wrong.
It's a great story to if you're going to take a cross-section of any part of this whole financial crisis story, AIG is a great place to start just because it's such a terrible example of everything that could possibly go wrong, did go wrong. AIG's particular role in this scandal was that they were trading heavily in a type of derivative instrument called credit default swaps. And it's complicated what those things are. It's sort of like a kind of insurance that helps investors hedge their investments in things like the mortgage market and the housing market. But there's a sort of a loophole with credit default swaps, which is that you can sell as much protection as you want to these investment banks without having to actually post any collateral at all.
So they were coming into those when the bank said to them, well, we've bought these derivatives, we're not sure how it's going to turn out, packaged, bundled mortgages and all the rest. We would like you to insure us in case it all goes bad. They said sure, without having to have any money to pay out.
And AIG essentially sold somewhere between $450 billion and $500 billion worth of this protection, and they just didn't have that money. They didn't have a fraction of that money.
And why were they legally allowed to do that? Don't we regulate insurance?
Well, this is an insurance. This is a credit default swap. It's a type of derivative instrument that was specifically exempted from regulation of all different types through a law that was passed in 2000 called the Commodity Futures Modernization Act. You can't regulate them as securities, as futures, or as gaming, and as a result, there was really nobody who had a specific mandate to look after these kinds of investments in the regulatory arena. So he essentially made a $500 billion bet with money he didn't have, and when it went wrong, the government had to step in and pay it off.
You said that in the relevant agency there was one insurance specialist.
Right. Due to another kind of loophole in the sort of regulatory environment, AIG was essentially allowed to choose its own regulator. There's a small office called the Office of Thrift Supervision, which Robert probably knows a lot about because it was created in the wake of the savings and loan crisis. Specifically to regulate thrifts, which is another word for savings and loans. And all these holding companies had to do was open up a thrift in one place, in one state. AIG opened one up in Delaware, designated itself a thrift, and chose the OTS as its regulator. And the OTS was the smallest and weakest of all the regulatory agencies, and they only had one insurance expert on their staff.